So, China's latest financial data, well, it presents a bit of a puzzle. On one hand, the money supply is surging at a rate we haven't seen in over 4 years. But on the other, the private economy feels incredibly weak. In this analysis, we're going to deconstruct this disconnect. What we'll uncover is a two-track economy, one that's being driven by a powerful but very narrow policy pulse. And this is the number that really got everyone's attention. A 7.2% year-on-year jump in the M1 money supply. Now, M1 includes things like cash and corporate demand deposits. Basically, it's the most active form of money. It's usually a pretty direct signal of economic health and business activity. And to put that into perspective, this is the fastest M1 growth we have seen in 55 months. A surge like this, at least by any traditional measure, should be pointing to a booming economy. But it isn't. And that's the thing. This seemingly strong indicator is completely at odds with the broader economic feeling on the ground, not to mention other key data points that all suggest a persistent weakness. So that brings us to the central question we're going to tackle. What is really going on here? Okay, so let's get right to our core finding. This M1 surge isn't what it looks like. It's not an organic recovery. We're calling it a policy pulse. What that means is it's a direct injection of government funds, mainly into state-linked sectors. And while this liquidity creates the illusion of growth, it's getting trapped. It's not circulating, and it's masking a really deep lack of confidence in the private economy. So, first things first, let's really break down this M1 surge and understand why this seemingly positive signal is, when you look closer, actually a false dawn. And to do that, we need to talk about a concept called the M1-M2 scissors gap. Now, usually, when M1 growth speeds up and starts to catch up with M2 growth, that's a great sign. It means money is moving out of savings and into more liquid accounts to be spent or invested. It's a sign of life. But the way this gap is narrowing right now is anything but typical. And here's our first major clue. Just look at the divergence here. While M1 growth shot up to 7.2%, the broader M2 measure actually slowed down. So money isn't moving from savings into the active economy. Instead, we're seeing this fundamental disconnect between the two. So here's the three-step process that's really crucial to understand. 1. The government, through accelerated fiscal spending, is directly transferring huge sums of money into the accounts of state-linked companies. 2. That technical transfer instantly pumps up the M1 number. But 3, and this is the absolute key, those funds are just sitting there. They're not being used for new investments or hiring that would push the money out into the wider economy and lift M2. The money is effectively stuck in a liquidity trap, which tells you the transmission mechanism is broken because the private sector just doesn't have the confidence to act. Okay, so if the money supply data is giving us a false signal, where do we find the true story? Well, you find it in the credit market. You have to look at who is borrowing and, just as importantly, who is not. And the data here reveals a really sharp divide. On one side, you've got the public and state-owned sector. There, credit is holding up, but it's all driven by policy directives, think infrastructure projects and debt restructuring. Then you have the other side, the private sector. And that story is one of deleveraging, really weak loan demand, and a clear avoidance of any long-term debt commitments. This chart really puts some hard numbers to that divide. The data for new loans is just stark. While that policy-driven lending is providing a floor, just look at the other two slices. New loans for private corporate investment and for consumer spending, they actually contracted year on year. The engine of organic growth, it's clearly running in reverse. That reflects some deep-seated caution from both companies and households. You know, the year-on-year drop in new medium and long-term loans to companies is maybe the single most telling piece of data in this entire report. It's a clear signal that even with plenty of liquidity and low interest rates, private firms just don't have the confidence to invest in their own future. So when you put these clues together, the policy-driven M1 surge and this divided credit market, they point to a much, much bigger shift in how China's economy is being managed. We're seeing the emergence of what's called fiscal dominance. So what exactly is fiscal dominance? Well, think of it as an environment where the government's budget and its spending decisions, not the central bank's interest rate policies, become the main force shaping credit and money in the economy. In other words, the price of money becomes less important than the policy-directed flow of money. And this table here, it really lays out the new playbook. In the traditional model, we would all be watching the central bank and interest rates. But now, under fiscal dominance, the real driver is the Treasury and its state planners. Credit is flowing where policy wants it to go, not necessarily where market demand is. And that means the key data to watch is no longer just rate decisions, but fiscal announcements and actual spending.
Given this reality of a two-track economy, how do we even begin to analyze it? Well, a pretty logical framework actually emerges right from the data itself, what we call the barbell.
Now, to be very clear, the barbell framework is an analytical tool. It is not a recommendation. It simply suggests that in a split economy like this one, a logical approach is to focus on two distinct poles. On one end, you have highly secure assets that can benefit from overall macroeconomic weakness. And on the other end, you have very specific assets that are the direct beneficiaries of targeted policy support. The idea is to avoid that broad middle ground that's just exposed to the general weak economy. This table breaks down that logic. Government bonds, for example, they align with the reality of weak aggregate demand and the potential for more monetary easing. Then you have policy-backed sectors, which align with the reality of direct fiscal support. And that leaves the broad market sectors in the middle, exposed to all the headwinds from weak consumer confidence and private sector deleveraging. So finally, where does this story go from here? Let's identify the key indicators that we need to be watching over the next few months. Looking ahead, these are the critical data points. First, that M1-M2 gap. Will it close because M2 finally starts to accelerate? That would be the first real sign of a successful transmission. Second, real estate sales. That's a huge test of whether targeted support can stabilize this critical sector. Third, future fiscal announcements. We need to watch the scale and the direction of the next policy push. And finally, we have to keep our eyes on those corporate long-term loans. Any sign of a rebound there would be a huge signal that private sector confidence is returning.
And all of this leaves us with one critical question. The data clearly shows that policy is building a bridge to support the economy. The great unknown, though, is whether it's a bridge to a sustainable, private-led recovery, or if it's just a bridge to nowhere, one that will require bigger and bigger rounds of state support to maintain.